Today I would like to analyze Kraft Heinz. So they are one of the biggest food companies in the world. We can see here some of their brands. You probably know them. When we take a look at the stock price, we can see in 1 year we are down 21%. In the 5-year charts, we are down close to 6%. So we had a recovery at some point around 2020. We did go up to close to 50%, and now we are down again. So we're going to take a look at the financials to find out if this company is undervalued right now. The first one we can recognize is a market cap of 35 billion US dollar. This is when we take the shares outstanding, multiply with the current stock price. So it's not a small company anymore, but it looks like it has still enough room to grow in the future. We also see we have a dividend yield around 5.47%, which is quite high. And we can take a look here as well, and we see the dividend did decline from 2016, and now in 2024 it still declined a lot. So we can see that the first thing we are going to take a look now is the revenue growth. We would like to see the revenue grow in the last 5 years because we want to invest in a growing business. So what we can see here in 2019, close to 25 billion US dollar revenue. Then we have a 4.8% revenue growth in 2020. Then we have a small decline in 2021, 0.5%. Then slow growth, 1.69% in 2022. And then in 2023, 0.59% growth. So overall, its revenue growth is not an incredible growth anymore, but it's still a check here. The next thing we're looking for is free cash flow growth in the last 5 years. This is a very important number because the free cash flow can be used to pay back the debt, to pay the dividend, to pay the stock buybacks, or to invest in the business. So we can see here in 2019 it was around 2.78 billion. Then we have the 55% growth in 2020. Then in 2021 close to 3% growth, and then we have the strong decline in 2022 around 65%, and then we have the recovery in 2023 and we have the 90% growth, but it's close to 3 billion again. So overall we have a growth from 2019 to 2023. Is a small growth, but still, so for me it's a check here. The next thing we're looking for is free cash flow yield over 4%. This can also tell us about the valuation of this company. So if it's under 4%, it could mean the company is overvalued. What we're going to do now is we're going to take the free cash flow from 2023, 2.96. We're going to divide it with a market cap of 35 billion. And then we're going to get the free cash flow yield. So the number we get is 0.0845, which means around 8.45% free cash flow yield, which is very high and is a good number. But of course, it also can have a reason that it's so high. Maybe this company has some other issues. So it's a check here for me. The next thing we're looking for is debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. So a very important number as well, because if a company has too much debt, it could risk to go bankrupt. So what we're going to do now is we're going to take the short-term debt here. Then we're going to add the long-term debt as well. You can see here's the short-term debt 754 million, and here's a long-term debt around 19.9 billion. Then we're going to divide it with the free cash flow that we had. And then we're going to get the debt to free cash flow ratio. So the number we get is 6.97. So it means in close to 7 years, we can pay back the debt with the free cash flow. So it's not under 5. So it's not a check here, but it's not a very bad number as well. Of course, they have a little bit too much debt, but I think if they can pay back the debt, is not looking so bad. And we can see here actually they did pay back a lot of the debt they had here in 2019, around 28 billion long-term debt. Then we can see here 2020 it's close to 21 billion, and now it's under 20 billion. So yeah, they pay back a lot of the debt already. This is something good to see, especially when the interest rate is high. We can also take a quick look at the cash on hand that this company has, and we can see here around 1.4 billion, which is not so bad, I would say. They can use this to pay back the debt or to invest in the business. We can also see they had more cash on hand some other years, so probably they use this to pay the dividend or to pay the debt. Yeah. The next thing we're looking for is shares outstanding decrease in the last 5 years. This means the company buys back their own shares, and we like to see that especially when we think the company is undervalued. So what we're going to do now is we can see here the shares outstanding did increase many times in a row, but since 2023 we have a slow decrease of the shares outstanding, and in 2024 we had around 1% decrease of the shares outstanding. So it means they did buy back their own shares. We can see it as well, I think, in repurchase of common stock. Yeah, here in 2023 they did have a stock buyback. So I would say it's a check here. Shares outstanding did decrease in the last 5 years. I would like to give my conclusion about this company. So let's start with the positive. So they had a revenue growth and a free cash flow growth in the last 5 years. Of course, it was not very high, so we have to say that as well. The free cash flow yield around 8.45% looks very good. It could mean the company is undervalued. The high dividend yield around 5.47% is look also very good. We have to say the dividend didn't increase many times in a row. It actually declined many times in a row now. The balance sheet also not looking very good. We have to say it's a lot of debt and the cash on hand is okay. But we also have to say they did pay back a lot of the debt as well many times in a row now. So the next thing would be the business. I'm not quite sure if this business is still very profitable in the future. It's about how popular are the brands, how much products they can sell. Of course, nowadays we have a lot of supermarket brands that can offer similar products with mostly cheaper prices as well. So we have to consider that. But overall, this company looks interesting, especially with the high free cash flow yield.